All right, good morning, ladies and gentlemen. It's 10 o'clock a.m. on the East Coast, and today is April 1st, April Fool's Day 2020, and we are back with another edition of the Investing Systems live show. And joining me today is Jeffrey, and we're going to dig into some further discussion on the recovery stocks, the brand new recovery watch list that we've introduced into the service. So let me pull up the SPY here because I don't have anything drawn on the SPY, and so I like to look at the SPY with literally nothing on the chart but the price. And then, of course, on the S&P 500, I have a bunch of trend lines and support lines drawn. Real quick, before we get into this, let me just show you what I have drawn on here, Jeffrey, and you can maybe comment on this. So I'm pulling up a weekly chart of the S&P 500, and I have an upward sloping trend line that's drawn, it's drawn from the lows back in 2016 all the way to the low there in 2018. I guess this was like the end of the year type of thing. And so what's interesting about this is notice how the current weekly price bars are finding a bunch of resistance at the underside of that trend line right there. Right? That's kind of, it's poked above it a couple of times, but we're seeing, a lot of resistance like sort of at the underside of that trend line. And the fact that it goes back so far is just kind of amazing. What do you make of that?
Yeah, this is a great chart to look at. It's always good to pull back to a much bigger time frame. A weekly time frame is good. Sometimes I'll look at the monthly time frame to see also how things are going on. But the way you've got the support and resistance lines drawn is like perfect. This is exactly, I mean, there's certain situations in the market that are not that difficult to try to understand, and this is one of them. It's pretty straightforward. Markets drop down below that red line there, that support, the previous support, and basically now we're trading like right in the middle of a big, like, no man's land, a big range, and we're still below that upward sloping trend line that you got drawn there. And didn't we just have like the big death cross like a couple days ago or something?
Yeah, as a matter of fact, the S&P. I've got another chart here. There you go with the 50-day and the 200-day, or the 50-day crossed down through the 200-day moving average, and so that's the proverbial death cross that you just
Mm-hmm.
mentioned. And it's interesting how the 200-day moving average is this gray line here, and it's just sort of interesting how flat it's been, right? And let me zoom out. This is a daily chart now, so this red line, which you also saw on the weekly chart, this is like the lows from these are the two lows from 2019, and they're kind of in the exact same spot, really. I mean, really super close. And I figured that was like the really big support level was those two previous lows. But anyway, the 200-day moving average had gone pretty flat, and it's almost imperceptible, but at this point, it's just now sort of looks like it's beginning to slope down. Can you see that?
Mm-hmm.
It was had a real gradual slope up, and now it has a real gradual slope down. And so, I don't know. I
Yeah.
mean, go ahead. I was going to say that I've
Oh,
been
finish
led to
up.
believe that the 200-day moving average going sideways is not really as good of a sort of a point as if it's actually has a decent slope to it.
Yeah, I mean, obviously, I think the 200-day, if I remember correctly, equates to what is it, 40? There's some kind of like
Like a
equation.
30 week or something.
30 weeks, yeah.
Yeah.
And so, like if you put a weekly chart up and you put a 30-week moving average on there, a simple moving average, you're going to get approximately like a 200. Obviously, there's a difference because the 200-day is computed off the closings of the days, and the 30-week average is computed off the close of the weeks. But you're going to find that they're probably pretty close. What's interesting on this though is notice how the market basically kind of magnetically got hooked up to that 200 there for a little bit, right?
Hmm.
Because that's the 200 is something that is watched quite a bit. So yeah, I think what's going on here, as far as like what we can ascertain about like what's next, like what's going to happen. Well, we don't really know because you know the issue here is the market is very news driven right now. We were definitely due for a sell-off, okay, from a technical standpoint. I was telling people for the longest time, beware, and this is a good time to start trying to look to short the market and all this. I was saying that for weeks.
Well, sure. Look at
Yeah.
this. Look at the run up here from October. I mean, the market was literally going parabolic here, like from October to to early February, where I have this particular trend line. That was sort of an unsustainable kind of 45-degree run up in the market,
Yep,
over a
yep,
long
yep,
period
yep.
of time.
So, right. And so we were due for a technical sell-off. Now, this was a doozy because we had the perfect storm, the 1-2 punch. We had the technical setup for the sell-off, and then the news catalyst was a big one, right? Obviously, we know
Sure.
that. And so we got a once in a generational, market meltdown, right? You and I
Hmm.
haven't seen. Well, the last time we saw something like this was probably the dot-com crash,
Yeah.
right?
Well, 2008 was kind of,
That was, yeah,
the
that was big
housing
too.
the housing bubble, but that
Yeah,
one
yeah.
sort of started off slow, and then built up steam, over time, and then it got really nasty after it had been nasty for a while. This one started off, like you say, just really nasty. One of the more interesting things about this is, to me anyway, is see this little dip right here? Like this little dip right there was when all this pandemic in China stuff was hitting the news. And I'd watch the news every night and they would talk about, this flu in China and all this. And so it took that little dip, which was, a few percent. But the more amazing thing is that it basically, the market shrugged it off for a couple of weeks, like, it was no big deal. And so, this little section up here was, I guess, what you'd call a classic bull trap, or yeah, bull trap, because this sell-off was due to this outbreak of the COVID-19 in China, and then the market decided for a short period of time that it was no big deal. And then, of course, right over here, all hell broke loose, and this was my original support line. Besides the trend line, and this was sort of the original support line. And once it broke that, you can see it sort of took off quickly to the downside.
Yeah, well, this is definitely one for the textbooks, that's for sure. So the question is, like, well, what's going to happen next? Like, if we're trying to predict, are we going back up from here? Did the market already put a bottom in? Some of the market pundits are saying, oh no, we're going to go down, we're going back down, taking out the lows, and we're going to go down lower. And so we really don't know because a lot of this is just the market is going to be kind of tied to the news
Hmm.
and the economic situation and all that as well. So all we can do at this point, because of the situation, is realize we got like one of three options. One option is that, yeah, we did put the low in, and lows get put in one of two ways usually, which is a real sharp spiky V reversal, and that's what we see there, right? We have that nice big V reversal, uh, or they will kind of bottom out and stay stuck in a range, and the market will hem-haw around and cycle up and down for a while, and it's kind of a gradual grind back up, right? So now the thing about the V reversal though is it's kind of suspect because look, we had that several day like bounce back up right up under your red line there, that resistance line, and so basically we got one of three options, and we're not going to be able to guess what's going to happen. We're not going to be able to predict what's going to happen. We're just going to have to play the odds. And the three scenarios is yes, this is the bottom. That big sell-off there was the climactic sell-off. We got a V reversal. We're going to go up from here, or we're going to run back down. You see, we're gapped down today. We're going to run back down, and so the second scenario is we run back down and we just retest that low there where you have the yellow line. That's kind of like the main support area.
Hmm.
We'll run back down and retest that, and then we'll cycle up and down in this range for a while. right? And then maybe go higher. And then the third option is we do go down, retest the very, very, very lows, and the market even goes lower. And a lot of market pundits, I'm hearing them say that's what's going to happen. And because they're not convinced that we have had the huge, climactic sell-off yet. So basically, we can't predict what's going to happen, but we can play the odds. So basically, you divide by three, we have 33.3% odds of one of those three options happening, right?
Mm-hmm.
And so when we get in and look at some of these recovery stocks, we'll talk about how we can play those odds on the recovery, because you don't want to bet the farm on saying, okay, this is it, because that's how people take big losses, is they lump sum and bet the farm on one bet, and that's usually what gets people into trouble. So we'll talk about like how to play this strategically based on like the odds.
One of the things that one of the things that sort of strikes me is the the quickness, like the speed and the severity of the sell-off was, and I believe from like the all-time high to this low was like 37%, right? And so at this point the market's, roughly down about 20% off of the high. And I think how quickly it happened took everybody off guard. And there's so many people that are looking to buy and looking for all day long on CNBC. I see these professional guys come on. Oh, this is a great buying opportunity. This is a buying opportunity. This and that. And typically, the old saying is that bull markets end on euphoria, which is debatable whether this sort of parabolic move up was euphoria, but there was a lot of complacency up at the highs, given the fact that we knew something was going on, and it seemed like the market was just had a lot of complacency built in, and then you get this sell off, and bear markets, which I guess we this is considered a bear market, 37% sell off like that. Anyway, bear markets tend to, it's a psychological thing. They end when everybody with despair, the opposite of euphoria in a bull market. The bear markets end with despair when people are not looking to jump right back in and load up on stocks and all that. And so, a lot of it, obviously the psychological aspect of it is subjective, and you have the sentiment to deal with, but I wouldn't say at this point that the sentiment is really just washed out, right? Because of how everything transpired so quickly. So it's just kind of an interesting thing, because I like to kind of keep tabs on the sentiment, and I don't think obviously anybody knows what's going to happen from here, because as you say, it's extremely news driven. And so one other thing to look at here, which I was going to ask you about, this is an unusual sort of outlier day, right? Like most of the price action prior to and subsequently, after this low right here was sort of, call it 2300 to 2450, like this zone. But that's I guess you'd call that a pivot low, right? I mean, that's an extreme example of like sort of a pivot low outlier bar. And so what you were saying is like maybe the market does come down and sort of retest and do some more work, at lower levels without actually taking out this low. So many people I see on TV, talk about a retest of the lows. It seems to me that the conventional wisdom right now from the people I see interviewed on TV, on CNBC, which I watch all day, is that, the market's probably seen the low, but it's not out of the woods yet, and we may see a retest of the low. And not very many people are actually talking about, breaking the lows and going lower. So that's kind of where we are as far as the sentiment goes here.
Yeah, well, that one day that you've got circled in green, uh, that is a climatic sell-off day, and a big big spiked low, pivot low right now. And the thing to understand about this and about what's going on in the market is, you notice how then the very next day was a big pop-up, right? And then
Mm-hmm.
we started to climb off that. Well, half of that day there, or half of the reason for the big bounce is the short covering, because that day that you got circled is an obvious trigger to protect the short positions, right?
Hmm.
Because again, we're talking about, if we talked about that the day where we got the big run up and then the gap up. This is a similar type of thing after the huge rundown, uh, and people are looking at the the zone also. You could probably line it up with some previous support, and then we get that outlier day that you're talking about, and that was probably the day that there was massive short covering, and that just converts into buying pressure, and voila, we pop back up. So that's one of the reasons that this move might be a little bit suspect, is because half of it was just short covering, right? It wasn't everybody saying, "Oh, this is the greatest time in the world to buy." This is more of a technical knee-jerk reaction. So, yeah, it's going to be difficult to tell. Like I said, we got one of three options. We did put in the bottom, and we're going to, this is it. We're definitely zooming back up now. Or we're going to waffle around in this big zone here, maybe running down towards your little yellow line there. Or we do head lower. I think the case for heading lower is how much more of this pandemic news we get. I mean, if the pandemic worsens, then yeah, I think we're going to take out that low.
Yeah, and interestingly enough, this particular day, there were a lot of people. I won't say a lot, but there were people calling to close the market. Guys were coming on TV being like, "Oh, they need to close the market now until things settle down." And I mean, that was like the maximum point of freak out. And I kept thinking to myself, that would be the absolute worst thing that they could possibly do is close the market, because then when the market gets closed like that, and I'm trying to think, the only time that I can remember the market ever actually being closed was 9/11, after 9/11.
Yep.
And then as
Yep.
soon as they open it back up, man, there's just an avalanche of selling. And so I'm really thankful that they decided to leave it open. But I think people were going nuts because of how it sold off so quickly. And this was the exact day where, these couple of days here, you heard, and I mean, even these Wall Street professionals, these money managers, hollering for them to close the market, which I would have thought is crazy. But okay, so interestingly enough, we've got like this huge sort of zone right here, and the red line doesn't really match up exactly with that low right there. But what I wanted to do was sort of segue into these slides that you brought, and you can look at the pattern. You can look at the pattern on the S&P here, and then let me pull up this first slide that you sent here. There you go. So this is I see you got this tagged Citigroup here.
Yeah, this is just an example, a good example. What I wanted to do is talk about on the recovery stocks. And you can see there, what I did is I just marked this up so you can see the red line, horizontal line is where the system stop is. And then you got the two targets, the T1 and the T2. Those are the retracement targets. And just to review, the concept here is that the recovery stocks and ETFs are stocks or sectors that were super strong. They're still fundamentally sound, and they're expected, when the dust finally settles and the value buying kicks back in, and the institutional accumulation kicks back in, these will just naturally kind of float back up into those levels. And the reason that the T1 and the T2 are you want to watch those levels is because those are retracement levels, meaning that that's where we have overhead resistance. So in other words, the market and these recovery stocks will have a relatively easy time to get up to those levels, but once they hit those levels, that's where there's pockets of overhead resistance. So it's going to make sense for us to pull some off the table at those levels. And one of the things you want to think about with the recovery stocks is we've got a big list of them, and again, these are stocks that were in strong momentum uptrends before. They're fundamentally sound, and they got dragged way down because the market sold off so heavily. So when the dust settles, they're likely to rise back up to those levels. Now, the question is, how do we take entries and how do we play these stocks? So the unlike the swing trades where we give you the exact trigger level and the trigger day and all that, and the trailing stop, we've got a little bit more freedom here, and these can be longer term positions also. I mean, some of these recoveries, it might take several months to get back up to the T2, right? Depending if the market makes a lower low, it might be 6 months from now before the recovery starts.
Mm-hmm.
So you got to be a little bit more patient on these plays. The other thing is that, so we got several ways we can play these. One is you can do swing trades, right? So let's say you take a swing trade and you get a couple good days in your favor, and maybe we get a big long range up day and a gap up, like we talked about, that price volume crescendo. Take the profits, right? You can create your own little swing trades in this zone here. So what you want to do when you look at these stocks and mark the charts up yourself, you want to probably mark it up just like this on your charts at home, and look at the stop level, look at T1, and your playing zone is in the middle there, right?
Mm-hmm.
So you can decide, okay, do I want to do short-term swing trades, or do I want to buy and hold for the big retracements? Do I want to accumulate? You can do gradual, like dollar cost averaging accumulation within that zone, right? But one thing I'll just mention before we get started is you want to respect the stop levels. Okay, the stop levels, that's your maximum drawdown, right?
Mm-hmm.
I mean, you don't want to let it go. Don't fall into the trap like, oh, this is a great recovery play, so I'm going to just average down. No, because things change, right? Some of these stocks could all of a sudden have problems erupt and the fundamentals turn or whatever, and they're going to go much lower, let's say. But for right now, they're in the list. But this is just one example, though, how and I didn't put the trigger day on this. Do you know what the trigger day was on this?
I'll pull it up and let you know in a second.
Yeah. I think it was like 3 days back, 4 days back.
It was actually 326.
Okay. So, right. So what I'm showing you here is this. We're above the stop level. This stock has triggered. Yeah, let's just take a look there.
Yeah, and I'll go ahead and mark the downtrend line that you have right there too.
Yeah.
So there we go.
Okay, so that's basically where it triggered. So one little great play here is you can just mark your charts up and draw overhead resistance lines, and you've got a zone to work in now. You know where the maximum drawdown level is, where if you're in a position you want to stop out there. Remember, the stops, you always want to take the stops, because if you don't, that can lead to a catastrophic drawdown. One bad trade could just draw your account way down, so you never want to let anything run away from you. Remember that if you get stopped out, you're going to get another chance to take an entry, because these are, most of these stocks are going to just stay in this list. Even if they go lower, we'll get a new trigger down the road, and you can play it the second time, right? So, but this is just an example of how you can mark your charts up yourself and use this. So let's say that you see my little gray arrow there. Mm-hmm. Let's say that as you draw your overhead resistance lines over, like, pick multiple days, like this example, there's like 4 days there. That's great. And you can play these where let's say we had a big up close day, take the position, and you could protect the lows there. You see where I got that little curved line there? That could be your trade, right? You could take that position, protect those lows, and that gives you a much tighter tolerance, so you could actually take a bigger position, right? Mm-hmm. So there's multiple ways to play these recovery stocks. And so that's just an example. But any of these stocks that are in the zone above the overhead resistance line, very simply, When you get a little spiked high, a little pivot high like we have there, and you get a pullback, it's real simple. What the system is giving you are the big macro setups, and then you can work like this within the zones, right?
Hmm. Yeah, it makes total sense. That's actually kind of a nice little setup too. You get kind of the big sell off, the either the V bottom on a lot of these stocks, or sort of a congestion at the lows and then a little rally, and then that next pullback sets it up pretty nice there if it gets forward momentum. So I like that.
Yeah, this is actually, we actually got a good scenario for this recovery, because the worst thing would be that we get the V reversal and everything just runs right up to T1, like, in a couple days, right? That would suck.
Sure.
There's
Yeah.
no time to get in. There's no time to accumulate anything. So it's actually good if we run back down and kind of retest some of those lows maybe, and, even get closer to that stop level. And then it's very simple. Just draw your overhead resistance line, and the first day that closes above the overhead resistance line, that's your buy trigger. And then you can decide if you want to have a really tight stop under the recent lows, or you want to just use the main system stop.
And I guess, position sizing obviously has a lot to do with this, right?
Yeah, actually, and if you pull up that next slide, then I'm going to show you a cool methodology to play these recovery stocks.
All right, yeah, I got it up for you.
Okay, so now let's say, I don't know the exact count of symbols we have in that list. Maybe you can count them real quick for me while I'm talking. But we've got a nice little stable of stocks to work with, right? And what I recommended in the documentation there is, if you've got the capital, you probably want to diversify a little bit. All right, that's always helped, because again, when you lump sum and place one big bet at one level, that's where you take big losses, right? If you're wrong. Whereas if you distribute things out a little bit, you place smaller positions, you keep the risk really low, and then so you got diversification across several instruments, but then also you have like the concept of time diversification. You're not dumping everything in at once. So here's an example of how you can play these recovery stocks, and I don't want to use the word 100% guarantee, but I'm going to get real close to that. If you follow this strategy, and you have to push through it too, I mean, you got to follow it, you're almost going to be guaranteed to be able to profit from this recovery. Okay, and here's how it works. So obviously, everybody's going to have their different size account, different amount of risk, different amount of capital to work with. And so what you want to do is you want to say, okay, how much money in my account do I want to designate for these recovery plays, right? Maybe you're going to use some of the capital for other swing trades or whatever, but decide right away how much you're going to use for your recovery campaign. And then what you want to do is you want to pick multiple vehicles if you can, and you're going to start like this campaign, this recovery campaign, right, across several vehicles. I mentioned in the documentation you might want to like play a little bit of everything. There's a ETF for the crude oil. That could be one of the the plays of the generation. We got oil at 17-year lows, and again, it could go much lower, but we know the oil industry cannot continue with the prices that low. So it's gonna have to, one way or another, it's going back up. They're gonna have to manipulate the price to have it go back up. We can't tell when that's gonna happen. It could start next week, it could be months, but it's definitely going back up. So that's a good one to keep on the radar list. You can look at several of the stocks in there. Maybe you've got a preference on some of the stocks you want to play. There is a reverse ETF for the VIX. That's the fear index. That's going to be a good one. As things settle down, the VIX is going to drop. So you've got a lot of different cool candidates to work with. So what's the best way to do this? Now, I mentioned if you lump sum, that's kind of the primitive, dopey way to do things, and also the riskiest way, because you're basically putting all your chips on one bet. And if you win big, great. If you lose, you're going to lose big. So you don't want to do that. Here is a little strategy. So what I recommend you do is take the maximum amount of capital that you're going to designate for the recovery campaign and divide it by the number of symbols. So let's say that in this example, I'm giving you an example of if you start off with, if you're going to use 25K. So you would divide that by 5, and that would give you up to 5 positions, right? So this would be just one position. So you can see you got the symbol DIA. That's your market index there. And so what you do then is you divide by 5. That would give you your maximum position size for each symbol. All right. So in this example, you got 5K. If you were going to do 50,000 for each symbol, it would divide out to 10K, right? So then what you do is you can see each attempt, you're going to increase the size. So attempt number 1, your first play in the recovery, is your smallest position. So in this example, you'd take a $1,000 position. You basically take, 1,000 divided by your entry price is going to tell you how many shares to buy, and then you can just decide where that stop's going to go, what kind of stop you want to use. Now, in this particular example, because you're going to be diversifying across multiple symbols, and we very well could get multiple attempts on each one, things will average out. So in other words, your stop doesn't always have to be the same on every trade you take, right? Like one stock might have different ATRs, and your stop might be a little bit further, or the system stop might be a little bit further, and don't worry about like every stop's got to be exactly the same percent. Right? Because over the series, it all kind of averages out. Does that make sense, Bill? And so, yeah, in this particular strategy, focus on just using the dollar amount for your position size for each one of the attempts. And so let's take an example here. Let's say that the DIA, the Dow, if you want to just play the retracement on the Dow, let's say our very first entry is stopped out. Well, the Dow is going to stay in the list, right? And if the Dow goes lower, it's going to, at some point, it's going to attempt to recover again. So the next attempt, it could be weeks from now, months from now, whatever, you would go with $2,000 position. Right? And keep in mind, the price is even lower. You're going to buy more shares, and you're going to buy, twice as much. Let's say that got stopped out. Then your next attempt is a $3,000 position. So this is a kind of a modified martingale approach. In martingaling, by the way, the old martingale betting strategy at the casino is, every time you lose, you double your bet. Well, the problem with that is your bet sizes could go into the stratosphere because it's possible to lose a lot in a row, right? I mean, the maximum, I think the world record for coin flips was, I think I mentioned it was like 17 times in a row it came up heads. And so it is possible to just lose. So you can't really practically double the size every time you lose, but you can see this is kind of modified, and what this is going to do is, what you're banking on is this. You're banking on the fact that within 5 attempts over time, you're going to be able to catch the dang recovery, right? And that's pretty reasonable. I would imagine that it might only take 2 or 3 attempts before we catch a sizable recovery. Okay, and so keep in mind now, if you're going to diversify and attempt and play the recovery like a campaign style with multiple symbols, one of them, like a particular stock, you might get in on the very first attempt, and that might be it. It might take off. And the other thing to keep in mind is you can get your positions to break even as well. So if you've got a stock that is moving in your favor nicely from where you took the position, you're not a long-term investor where you just sit back idly. You can go ahead and protect that position at break even. It all depends on what your time frame is. If you're going to do a small, short time frame swing trade, then use our little 3-day trick. 3 higher lows than your entry, you can just get to break even. If you're going to kind of accumulate and you want to hold for the longer term, go ahead and use the weekly chart, and you use like 3 weekly lows that are above your entry, and then you could go to break even on something like that. So the point I'm trying to make here is if you treat this all statistically and keep it like probability based, you're going to be almost guaranteed you're going to get a profit out of this recovery. Okay, so let's say that one of your stock symbols takes off, great news, and they're recovering, and they take off like a bat out of hell, and your very first attempt is a winner, right? It starts retracing back up. And in fact, one of those stocks that we got, like AMD or something, we can take a look at it later, is one of the ones that is a good one to look at for that. Now, let's say that another one of your symbols stops out, and you're out of it. You take a second entry, slightly bigger position, and what that does is if that one works, that's going to make up for the stop out. You see, it cancels out your losses. And again, it's going to depend. But if we go back up to T1 levels, you're definitely going to be canceling out your losses with that. Another symbol may stop out twice on you, right? As long as the symbol is in the list, it's going to, we're expecting it to recover at some point in time. So you go on attempt number 3, right? Your position is 3 times the size of your original position. You follow me? So if you can, in your mind's eye, you can see that you can almost not lose on this if you follow this, statistically based type of an approach. And I would say that anywhere from 2 to 3 attempts, you're going to catch the recovery play. You're going to.
And so the actual recovery table is going to reset, if any of them, on the ones that actually do go down and hit the stop. And so the targets would adjust and the stop would adjust at different levels when that happens.
Yeah, basically, let's say that we went in and you got into your DIA recovery position, the first level, and that one ends up stopping out. Like I said, one of the scenarios is that the market's going to go down and make another new low, right? So let's say that happens. You're going to see in the recovery watch list that that will reset back to gray. It won't be green anymore, and then your targets and your entries and all that will zero back out, and then that symbol is just going to stay in the list because obviously it's the Dow is going to recover at some point in history, right?
Mm-hmm.
Right?
Oh yeah, they'll make sure it will because they'll kick out the stocks that are doing bad and add something that's doing good.
Well, and eventually, just remember, hedge funds and the big institutions, they got to get this money back to work.
Sure.
So they're going to become accumulation, value buyers at some point, and so there you go. Let's go back to the
Slide.
Yeah, slide real quick there. Now, so everything is well and good, right? So, but you might be saying, well, wait a minute. What if the trade works on the very first attempt? I'm just in the smallest darn position, right? How does that work? Well, one thing to keep in mind is, it's possible, but it's probably not, very likely that every one of these stocks and symbols on the list is just going to recover all at the same time, right? We might get some that are recovering. We might get some that are waffling around. We might get some that actually stop out. So if you are diversifying over multiple symbols, things are going to average out. Like, so you might get one, you might get one symbol that works off the very first attempt. You might have another symbol that takes 2 attempts. You might have another symbol that 4 attempts. And so you can see that then your position sizes will kind of average themselves out. Now the other thing that I'll talk about, and um, we'll go back to some chart examples in a minute, is let's say that on your very first position, the attempt number 1, your smallest position, that one works out. Like it starts moving in your favor. You can actually get to break even, no loss, right? No harm, no foul. And you want more, right? So guess what you can do? You can add in, you can average up. And so what you want to do there is averaging up is great, but it's a little bit tricky because if you do it wrong, then what you do is you just drag the average share price right up to where the price is trading, and you can go into a loss then, right? So you don't want to do that. So what you do then, I recommend, is if you, let's say that the attempt number 1 starts to work, and like you're already break even on your position, let's say, if you want, you can start doing add-ins, and I would recommend you cut the positions by 4, or divide by 4. So do add-ins of like $250 each, right? That will keep your average share price below where the stock is trading, right? You'll be able to add in and increase your size without risking either getting knocked out or taking a loss in that position. As long as you're trading above your entry price, right, and you are at break even. So the reason I'm mentioning being at break even, because remember what I said is that one of the ways you can get to break even is 3 higher lows. 3 higher lows than your entry is going to guarantee then that the stock is trading up above where you took the entry, and then that's going to be a safer zone to do an add-in because you're away from your entry point. Why don't we go through some of the ones in the list and just take a look at how they're.
All right, let me do that real quick. I'll just start at the top with
We can,
Target. And
and
so, yeah, this is the one. This one's got a trigger date of the 30th, which was just 2 days back. So there you go. So basically, let me ask you this. So this Target, like this was the trigger date, right? And it's sort of sold down since then. So would you be looking for an entry like basically sort of right above that that day and the prior day? You see those 2 highs there. I mean, that looks like a pretty good entry, because obviously you don't want to just blindly buy them, right?
yeah, well, draw your downward sloping overhead resistance line over like the last 5 days, like we did on that first
Yeah, you
example.
could basically right like that. There you go. Well, so here's my question to you: is would you look for an entry on a break of that trend line, or would you
Yep.
wait for it to get over? Because
No,
obviously those
I
couple of days.
look for a break above that trend line. Remember that once you put the stop in there, and that'll help us get a better picture also of what's going on here.
All right, the stop on this is just right there. So this is, I mean, obviously this is a pretty low risk. This would be a pretty low risk type situation because the stop is at 90.50.
Right. So here's again. These are a little bit free form. I mean, I wouldn't try to mix too many different types of setups in your campaign. I mean, pick a style that you want to do and stick with it across the series of the trades and all your instruments. And do me a favor, get rid of that horizontal line there that you have at like 98, and I'll be able to show something. Yeah, so 2 ways you can think about. Well, there's multiple ways we can play these. Let's go through just real quick how you can play these. One is to be real kind of hands-off and just play the statistics. And that is, the day you get a trigger, just buy the next day at the open, okay? And use the stops, right? And some of them are going to stop out, and then the next attempt you make, you follow that position size matrix, right? This is going to be the simple, easy, no-brainer way to do it. You get a trigger date, you buy the next day at the open, you put your stop in, done, right? The next method is to on your trigger date, you could put a horizontal line above the high of the trigger date and wait for a close above that line, or if you're going to be watching watching the market on the computer like the next day, you could have your buy stop entry in place just above the trigger day's high, right? The other method is once a stock triggers, you can watch for pullbacks like we're doing now. And so either way, what I would recommend though is if you're going to use the first method with you just buy at the open the next day, just again, don't bet the farm on any one of the entries. Keep the positions low to start and just use the big wide stops. Again, remember, this is going to work over the series and over time because we're going to martingale in. And a real important thing to mention is you have to continue the campaign, right? I mean, if you give up, you're likely to give up and you lock in the loss, and then you'll miss the big recovery, right? So you have to continue the campaign. Now, what I was going to say before you went off that chart there, can you
go back to it? Sure.
Yeah, real quick. Keep in mind that if you're going to do swing trades, remember that, let's say that on this example with, what is that? That's Target? Mm-hmm. Oh yeah, Target. In this example with Target. So let's say tomorrow we get another day where we close up above that overhead resistance line now, right? And you say, okay, I'm in. This one just happens to line up with the system stop. But again, if you're going to do like swing trades in here, you can play off the most recent pivot lows. And just remember that you're going to have potentially different distances for your stops on different symbols and on each attempt. But I wouldn't, in this particular kind of a strategy, don't worry about the differences because, again, they're going to average out over the series, all right? And basically that's what I was going to say.
All right, well, real quick before we wrap this up, I just wanted to, Apple's the most widely held stock on the planet, the most popular company in that, so I thought we would wrap it up by just sort of taking a look at Apple, and I'll go ahead and mark the stop here. And I've circled the day when it actually triggered, and so it's just kind of, it's just basically sort of hanging in here, right? It's interesting that the system calculated the stop is sort of where it is rather than, and I guess that makes sense because like that was the market outlier day. My guess is Apple's going to track pretty well with the market since it is the biggest component in the S&P 500.
Yeah, well, one of the things is the ATRs back down to that low are huge, right? Mm-hmm. So you wouldn't want to take a position up in the zone and then have your stop way down there. I mean, you could if you're going to let's say and there's still there's other strategies you can use. Like let's say that you want to be like more of a long-term investor and play this recovery, you could begin a dollar cost averaging little campaign as well. And that's real simple where I think we mentioned this last week. You just say every month I'm going to buy 10 shares of Apple wherever it's trading in here. And what you'd want to do is you'd want to wait for a day that looks lower during the week or during the month. And over time then you can accumulate above that stop level, right? And that's another way of reducing risk because if you get stopped out, maybe you only accumulated 3 times before you got stopped out. You didn't do the big lump sum bet. You follow me? Mm-hmm. So, but the martingaling approach is a sure thing as long as you follow the correct, pyramiding of the position sizes, and you have to stick with it. right? Obviously, if you capitulate and give up while if you have a drawdown, then there's no way to make the drawdown up. So
Well, which leads me to a question, and if you get say you took this one and got stopped out, basically you don't want to switch symbols midstream, right? Like you don't want to change your mind and say, well, I took a stop out on that, so I'm going to go to a different symbol. I mean, that sort of defeats the purpose, am I right? And so you would want to stick with the symbols that you started off with and use your martingale approach to,
exactly.
yeah.
Yeah. In other words, yeah, decide at this point in time which ones that you want to put into this recovery play. Now, here's the thing. I mean, this recovery concept, as long as there's stocks that have big sell-offs, you know, at some point they attempt to recover, right? And so our recovery list is not going to go away. We're going to probably keep this recovery list, and there'll be some new additions that come into it down the road. Some of them will drop off because they run back up, and they'll turn back into momentum stocks, right? There'll be this momentum swing trades in the future. We might have a stock that I don't imagine any stocks in this list, but I was going to say if anything changes with like the fundamentals of the company or whatever, or the buyouts or anything like that. I don't think there's anything like that in this list. Then it could drop off the list. But yeah, best thing to do is decide which ones you want to employ in this recovery campaign, and then you have to just stick with the matrix, the strategy. So.
Gotcha.
That looks pretty good, doesn't it? I mean, this is not anything new. I mean, I came up with this concept 15 years ago, probably. So this works really, really well. And the greatest thing about this approach, Bill, is it's very mechanical. You got the stocks in the list delivered to you on a silver platter, so you can just decide which one's in there that you want to employ. And it's also very, non-emotional, and it's, very probability based. As long as you just pull the trigger.
Hmm. Yeah, the other thing I would recommend right before we wrap this up is that you could go with an index, you could go with, like you said, oil or the VIX, and you could go with a couple of the stocks that are in different sort of sectors. And so we got the sectors pretty well covered here, right? And I mean, you got retailers, you got pharmaceuticals, you got financials, a couple of financials, you got an energy stock. Got Apple, and so yeah, that's the other thing is that obviously you'd want to sort of diversify when you choose your 4 or 5 stocks you want to play the recovery on, and then just stick, like Jeffrey said, stick with it. That's really the main thing, and this is also you gotta keep your mind around the fact that this is a longer term type thing, and this could play out literally over the rest of the year, right?
Yeah, exactly. That's the nice thing about this is you can basically, if you're going to go ahead and get to break even, and I recommend that if you're going to play this, for the kind of the longer term and try to play the retrace back up into target 1 and target 2, that you do use like a 3-week lows. You want 3 higher weekly lows above your entry, and then you can go to break even, right? Because a lot of times you get a stock that will run back down to your dang entry point, knock you out, and then turns around the next day and zooms back up in your favor, right? And you're out. So you got to give stocks enough time to wiggle around a little bit and get off the runway before you want to try to protect it too tightly, especially if you're trying to be in for the longer term. The final thing I'll talk about is this. Your diversification. Obviously, let's say that you're a young person and your grandparents gave you 5K or something. Well, you can probably either pick one thing to play or break it up into two things to play, whatever. But if you've got much larger capital, you could diversify even more. I wouldn't, the thing about diversification is this: the more you diversify, the more mediocre your results are going to be. You're going to have more managerial stuff to deal with, right? And so the ideal zone for diversification is probably around 4 to 8, right?
Hmm.
Somewhere in that zone. That's a great diversification. So the maximum number I would diversify up to would be about 10. I mean, if you got the capital, that would be the maximum. Any more than that, it starts your returns just are going to be mediocre.
Well, and you've got the all four index ETFs in this list too: the Dow, the S&P, the Russell, and the Nasdaq. And so, that's your just choosing one of those. You're instantly significantly diversified to begin with, and then you can sort of drill down into a couple of the other stocks that you actually
Exactly,
like.
exactly. Yeah, I would. Obviously, you don't want to. You don't want to think you're diversifying by buying all four of the indexes, because pick one of them that you like,
Hmm.
and maybe we've got the DBO in there. That's the direct ETF for crude oil, and then we got, what is it, XOM for
The stock.
that's a stock oil play. We've got so there's a good diversity of stocks in there too. We got telecommunications, we've got technology stocks, we've got uh, what was one of the other ones in
Retail and financials.
retail?
Yeah.
There, yeah,
There you go.
financials.
Pharmaceuticals. So there you
So
go.
so your list is diversified as well. So you got a great little plan here. And by the way, I'm going to just mention one thing. This is a beautiful opportunity. We do not get this is an opportunity of a generation. Trust me. I've had this like recovery strategy for ages. I came up with it a long time ago, but we just haven't had any good recovery, environments. I mean, this is a great one.
Hmm.
So load up the boat on this one, because this will be a nice recovery.
Very cool. Well, hey, thanks for coming on the show again today, and we can dig into this a little bit more next week, and maybe I'll mark up some of these things, and we can look at the charts once they've had a chance to, once we've had a chance for a little time to go by, and we see now that the quarter is over and we've started a new quarter, it's going to be interesting to see how everybody sort of positions themselves and what happens from here. And so, this time next week, have a pretty good idea of where we are, and so we can take it from there. So, hey, well, thanks for coming on the show, Jeffrey. Really interesting, and we will see you guys all back here next week.